Enphase Energy produces batteries and microinverters for solar power, and it's been one of the strongest stocks of the last 10 years. Based on the recent share price, the company has a market cap of $21.3 billion. With $1.8 billion of cash on the balance sheet and $1.2 billion of debt, the enterprise value is $20.7 billion. Enphase revenue really started to take off in 2018. Sales have grown from $316 million in 2018 to $2.6 billion over the last 12 months. Over the same period, operating margin has improved from 0 to 21%, generating an operating profit of $554 million today. Meanwhile, net income was $492 million and free cash flow was $832 million. That means the company is currently valued at 8 times revenue, 43 times earnings, or 25 times free cash flow. The company also pays out a reasonable chunk of stock-based compensation, around $229 million. But Enphase's high valuation multiple is underpinned by strong growth. As you can see from this table, Enphase experienced barely any growth pre-2018, but since then we've seen annual growth in the region of 50%, which is extremely impressive. And based on analyst estimates, that growth should continue. Analysts expect Enphase to grow 25% per year for the next few years and increase operating margin to 28%. This would lead to an operating profit of $1.3 billion and close to $1 billion in net income in less than 3 years. However, analysts don't always get it right, and that kind of performance is not guaranteed. For one thing, the solar energy market is extremely competitive. Enphase has done superbly until now, but new entrants are likely to put pressure on profit margins. More importantly, higher interest rates have caused the company to give a notably pessimistic guidance. In the latest earnings call, interest rates were mentioned 13 times. An Enphase CEO said that demand will unleash only when interest rates are back to normal. The problem is that interest rates aren't going back to where they used to be anytime soon, and you could argue that interest rates today are more normal than when they were at 0. So Enphase Energy starts to look like a company under cyclical pressure. And if you drop revenue expectations only a little, earnings projections start to look much less attractive. For example, if you drop revenue growth down to 15% per year, you get to around $5.2 billion of revenue in 5 years' time. A 20% net margin on that gets us to $1.04 billion of net income, and a 30 times multiple on that gets the valuation up to $31 billion. But the investment return on that number is only 8.5% per year. So Enphase Energy isn't going to fall off a cliff, but its share price can come under pressure from decelerating growth and a lower multiple, and that's a particularly nasty combination. This could well turn out to be a cyclical stock, which is why I give the stock a bearish rating today. But these are my personal opinions, not financial advice. I've got no position in this stock. For more detailed analysis, visit our website overlookedalpha.com.